We had some big news yesterday with the Fed slashing the interest rates, and it was the 50 basis points, with market undecided whether we were going to see 25 or 50. And for those that don't know, this is the first interest rate cut since the COVID pandemic in 2020. Now, how did the market react? As we can see, pretty much right across the board, companies are down, although fairly marginal, around 0.1% to around 2%. But what we have seen from the pre-market, it does look to be like investors are very happy, and right now we are sitting in greed. Remember, the market moves very quickly, sentiment moves very quickly. A week ago we were in fear, a month ago we were sitting in neutral. Now, today's episode, we are looking at 4 dividend stocks to consider in the portfolio. Now, each one looks to benefit from the interest rate cuts, and as we can see on each one in the pre-market, they are up. Now, the first one we're looking at is Global Payments, GPN, where we get a double buy rating from Seeking Alpha on Wall Street with a hold from Quant. Now, this one does trade in the mid to low end of the 52-week range with a yield around 0.9% and a forward P of 9.64. Now, over the last 12 months, it is down around 10%. Over the last 10 years, though, this has outperformed the S&P up 215%, although we do note all-time highs do sit around 3 years ago at around $220. Nice to report with this company, they are expecting over the next 4 quarters double-digit EPS growth year on year, and we can see from the historic 4 quarters they did outperform management targets. Also nice to report that December 2025 EPS increase is estimated, lowering that forward P down to around 8.47. Now, the dividend safety score does sit at 70. We do also note undervaluation signals that we will talk about. However, again, as we will cover, this company is yet to increase those dividends over the last few years. Now, it was reaffirmed a couple of weeks ago, the safety of the dividend, and ultimately means that a dividend cut is unlikely. Now, key metrics from the last recession, Great Recession 07-09, they maintained the dividend, again, didn't increase, also didn't cut it. They had plus 6.5% recession sales, which was above the S&P's negative 12, and they also outperformed the S&P negative 38, as we can clearly see here, the S&P itself negative 55. Now, whilst they haven't increased the dividend since 2021, we do note if you have been holding this over the last 5 and the last 20 years, not just outperforming the S&P, but you would also be having, on average, double-digit dividend growth. And whilst we see 0 years of consecutive increases, we do know they have been paying a dividend for the last 22 years without a reduction. Now, this is a new piece of data, and what this shows, given the current price, the expected price around 150 to 187 does give that undervaluation signal, and that can be clearly shown in this graph where we do note the stock price has deviated massively from the expected price. And when we just zoom in over the last year, in fact, what we are indicating here is that Global Payments has continually traded significantly below its fair value. Now, in terms of what we typically like to look at is dividend yield theory. Now, that is an undervaluation signal, as the current yield of 0.9% is above the 5-year of 0.74, and in fact the forward P of 9 sits below the 5-year average of 13.8. And in today's episode, we do get a triple undervaluation signal, as also the sector of financials at 12.1 does sit higher than GPN's 9.0. Bear in mind, we don't look at any of these models in isolation, and we will conclude towards the end. Nice to report as well, the free cash flow payout, which is the metric we use pretty much for dividend safety as well, and below 60% as the target, is something that is significantly strong with this company. In fact, 16% in 2023, 8% over the next 12 months. So whilst it is very low, we can clearly see over the last few years, management hasn't on purpose intended to increase their dividend, but we wouldn't be surprised if their next increase is something very, very phenomenal. In fact, perhaps a triple-digit dividend increase. Then we get to the free cash flow, where we want to see consistent increases over the longer term. Now, what we get here, in fact, is more than double from 2015 to 2023. Also nice to report, over the next 12 months, they are anticipating a massive jump to their free cash flow. In fact, double from the prior year position, which is always nice to report. And we can see for sales growth, where we want to see 3 to 7%, this company has done pretty much a lot better over the longer term, 8% in that more recent year, which ultimately, when we do take a look at it from a numerical perspective, we can see this company has increased their top line revenue more than triple from 2015 to the 9.7 billion reported in 2023. We will have to report though, with the shares outstanding, rather than returning excess cash to your pockets, they would have diluted your position from 2015, increasing it from 135 to 259, although do bear in mind from 2020 highs of 301 million, they have started to do share buybacks, hopefully something they can continue, and a little bit more aggressively as well, especially considering we haven't seen dividend growth in quite a number of years. One thing that we would like them to improve on is the ROIC, as we do want to see our personal minimum of 10%. We do note from the lows of 2% in 2019, it has started to increase, 6% on a trailing 12 month. Again, minimum 10% here, just to give us faith that management are able to effectively allocate their capital. Now, operating margin, we want to see operating efficiency with increasing margins over the longer term. Something we do see here, 16% to 23% in 2023, but again, a little bit inconsistent. Ideally, we do want to see gradual increases over the longer term. And nice to report, free cash flow margin looking very strong, very healthy, and continually above that minimum 5% point. Then we get to the final metric, the net debt to EBITDA, referring to the earnings before the interest, tax, depreciation, amortization. Now we want below 3. Reason for this is because this correlates directly to both dividend safety and balance sheet strength. With the numbers that you see below, the number of years it would take the company to pay off all of their debt net of cash on hand. 3.55 in 2023 is a little bit higher tto what we want to see. Nice to report, it is anticipated to drop over the next 12 months. But again, these are some considerations you should have with investing in this company, and ultimately you can use that when we come to the margin of safety. Now in today's episode, our intrinsic value of $160 does imply massive undervaluation. We can see Wall Street's forecast of $143, giving that upside of 27%. Now typically on this channel we do deep dives, we run through every single model. Today's episode, whilst we won't do this, we will just show you that effectively we haven't used the multiples valuation, as this company does trade at a significant discount, so this number would be severely skewed. And also, given they haven't in fact increased the dividend over the last few years, this model for now does deem to be redundant. So margin of safety, as always, 10% minimum, which we execute on if it meets our 3 golden criteria. Wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode for GPN, we'll buy up to $146. Then we keep going till it's near the current trading price. And what we in fact note in today's episode, we see this company at a 30% MOS, with Wall Street, as we mentioned, very bullish, 27% upside. They do believe this is one you should consider moving forwards. As always, do give us your thoughts as we go along today. We also want to let you know we have released our latest free weekly article. We send one out every single Monday with lots of information as well as our undervalued stocks for that week and that month. So do click below to grab a copy. And we have in fact also released our 25 undervalued stocks for the month of September for your consideration, where we also talk about those that sit within our portfolio. And in fact, just last week, we also released 22 of the largest upside companies in the S&P 500 according to Wall Street. So don't forget, click below, sign up, and you can have access to all of this information. We then move on to the second company, Taiwan Semiconductors, where straight away you can see a strong buy from Wall Street and a strong buy from Quant. In fact, 4.98 out of 5 showing here that Quant do see this as one of the best stocks to buy now. It does currently trade at the upper end of the 52-week range with a yield of around 1.31%, a P of 27 on a trailing 12-month basis, and as we can see already after the Fed's decision yesterday, this company from market open is up around 4.5%. Over the last 12 months, we're up 88%. Over the last 10 years, up 742, significantly outperforming the S&P. And if you do believe that this isn't an AI bubble, the revolution is here to stay over longer term, then TSM is definitely going to be one of those main key players. In terms of their performance, well, again, over the next 4 quarters, they are anticipating double-digit EPS growth, having also outperformed analyst targets over the last 4 quarters. And if they do hit that December 2025 EPS, the forward PE will come down to around 20.01. We can see as well, dividend safety score looks at around 62 safe, and we can see looking reasonably valued based on this method, which we will have a closer look at, with some very nice growth of double-digit 14% sitting there in May of this year. Now, in terms of taking a look at the last recession, well, actually, they cut the dividend, which wasn't a good sign. They had below average growth of negative 26%, but very impressive, massively outperformed the S&P, negative 25% recession return. We also like to inform you over the last 5 and the last 20 years, they have offered double-digit growth on an average year-on-year basis, although there is only 1 year of consecutive increases, with 20 years of paying a dividend without a reduction. Now, in terms of taking a look, we can see the assumption here of reasonable valuation, and when we do take a look at it over the last year, we do know based on this method of the PE, it is trading towards the upper end of the expected, although we will take a much better look when we run it through our own valuation model. What we can in fact see though, in terms of the yield, it is lower than the 5-year average, as well as the forward PE being marginally higher than the 5-year rolling of 21, but it is still marginally lower than the sector as a whole at 24.7. Now, when we take a look at this company with regards to the free cash flow, below 50% is what we want to see for semiconductors. Now, over the more recent year, we would typically call this a red flag indicator, which is why we focus on the free cash flow, not the earnings, which is susceptible to manipulation by management through accounting. As we said, this indicates management paid out more in dividends than they generated in free cash flow, something we have seen 2 more years over the last 10. Nice to report though, over the next 12 months, this is anticipated to come down to 63%. We can also see the free cash flow growth. It has pretty much doubled from 2014 to 2023, and in fact over the next 12 months, something that we do typically see with companies in the semiconductor industry, massive free cash flow growth expected over the next year. We also like this company in terms of their sales growth, nearly double digit every single year, although we do point out the more recent year, negative 5%, so a decrease to their top line, but 9% increase on a trailing 12-month basis. We do anticipate 2024 to be a very good year for Taiwan Semiconductors, and we can clearly see pretty much tripled their top line over the last 10 years. One thing they have kept very constant is that shares outstanding, which we can see hasn't moved over the last 10 years. ROIC looking very, very strong, well above the 12% that we want to see for semiconductors, and very, very consistent. Always great to see, and as I've mentioned before, I personally don't mind paying a little bit more for companies that do have that consistency. We also like their operating margin, both operating efficiency noted as well as consistently very high margins, 43% in 2023, looking very strong, and the free cash flow margin as well, no worries whatsoever, although we can see clearly here it does fluctuate on a year-on-year basis, 29% on a trailing 12-month. In terms of the net debt to EBITDA, this essentially highlights they have a phenomenal balance sheet. It wouldn't even take TSM 1 day to pay off all of their debt net of cash on hand. Now, in terms of our valuation, as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for TSM or any others. Now, $203 with our MOS at 10%, a buy at 183, at 15% a buy at 173. So we do see this right now, 15% margin of safety with Wall Street, as we can clearly see here, $210 price target. They see upside of 22%, and in fact we saw Quant as well giving this company a strong buy. Do give us your thoughts. Maybe the political risk with this company is a little bit too much, or maybe it is one you like but you would want a higher MOS level. We then move on to Humana Inc., where we have a buy rating from Wall Street and a double hold from Seeking Out from Quant. This one is trading at the 52-week low or thereabouts. We see a yield of around 1.12% and a forward P of 19.3. Over the last year, hammered down 33%. We have covered the reasons for this in some detailed analysis, so do check that out if you're interested. Over the last 10 years, up around 139%, not too far off the S&P's performance, although we can in fact see all-time highs sitting around $555 around 2 years ago. We do note a lot of inconsistency in terms of the future projections, and over the last 4 quarters they have outperformed 3 or 4, 75% track record, but what we can ultimately see in December 2025, EPS is anticipated to increase from the previous year, bringing that forward P down to around 15.71. We see here dividend safety score 99, very safe, in fact the highest score obtainable. We have an undervaluation signal, and something to note, we are still waiting on their dividend increase for 2024. So when we look at the last recession, whilst they didn't pay a dividend, we have no comparative data, they did have above average growth. However, they did significantly trail the S&P, negative 72%. Over both the last 5 and the last 10 years, we do get double-digit dividend increase from Humana, and we can ultimately see 12 years of consecutively increasing those dividends. Now we get an undervaluation signal based on the 5-year average, and in fact we can see based on the current price a lot of upside is anticipated, and it is clearly shown when we do look at the graph over the last 20 years, more specific over the last 1 year. Pretty much since the beginning of 2024, this company looks to be trading right below its fair value. In terms of looking at dividend yield theory as well as the forward PE, again a double undervaluation signal. The yield might in fact be the highest offered to investors over the last 5 years, and we do note here forward PE marginally lower than the 5-year average, although we do see in fact marginally higher than healthcare sector as a whole, sitting at 16.7. Now, in terms of looking at this company and the free cash flow payout, what we can see over the last 10 years, it has consistently been below 60%. 15 in 2023, a little bit higher expected over the next 12 months, but still well below that maximum level. And when we do look at the free cash flow per share, we can see more than 3 times increase from 2014 to 2023. And we do have to point out a drop anticipated over the next 12 months. In terms of sales growth, it does look fairly positive. Again, nearly double-digit increases every single year to their top line, 15% in the more recent period, and we can see more than double their growth from 2014 to 2023. One thing we also like about this company is that return of excess cash on top of those double-digit increases. Whilst they're not a massive amount year on year, it is a little bit like an added bonus. We also see very impressive ROICs right across the board, above the minimum 10%, especially over the last 2 years, sitting at 16% year on year. Margins, something that does leave to be desired, especially when you see that the minimum we want is 12%. Although if you have seen our episodes on other companies like ELV, like UNH, you will see they all have some very similar margins. So this isn't a surprise, especially in this sector. When we do look at the free cash flow margin, again, this does leave a little bit to be desired for. 3 to 4% over the last few years. Again, we want to see ideally a minimum of 5%. Then we get to the net debt to EBITDA, very, very similar to TSM. In fact, 0 right across the board. It wouldn't even take them 1 day to pay off all of their debt net of cash on hand. A very strong balance sheet. Now our intrinsic value just under $400, not far off Wall Street, 392. They see 24% upside. And when we do look at it in terms of MOS, well, at 10% a buy at 360, and then as we keep going to near the current trading price, we see that Humana Inc. trading at a 20% margin of safety, and as we said, Wall Street do like this company, a buy signal with 24% upside. We then move on to the Estée Lauder company, where we get a double buy rating from Seeking Out from Wall Street with an interesting sell rating from Quant. We see here trading right there towards its 52-week lows, with a yield bang on now at 3%, a forward P around 30, and we can see over the last 12 months that this has been absolutely hammered, negative 43% over the last 10 years. No surprises then why we see minimal growth at 18%, and in fact from December 2021, the highs of $370, this company has continued to suffer. Now what we do like about this company is that over the last 4 quarters, they have beaten by quite some distance the expectations of management and analyst targets, and we do note over the next 4 quarters, 2 of them they're anticipating double-digit EPS growth, with June 2026, $4.03 per share on the EPS, bringing down that forward P to around 21.85, and this could be one of those value plays you do consider if it fits within your own portfolio. Now we do notice here a 50 borderline safe dividend score, so we can take a peek, and we can also see that undervaluation signal. And one thing to remember with this company, they haven't increased those dividends in a couple of years. What does a dividend safety score mean of 50? Well, firstly, it was downgraded in July, and this ultimately tells us there is moderate risk of a dividend cut over a full economic cycle. Last recession, well, they maintained the dividend, didn't increase, didn't cut. Average growth around 10.5%, and they marginally outperformed the S&P, negative 52%. As we can see here, we are still waiting for a dividend increase, but over both the last 5 and the last 20 years, they have increased those dividends at a double-digit rate. And when we come to the valuation based on the PE, we get that undervaluation signal, and quite clearly that is shown. This company over the last year, in fact since May 2024, has been trading significantly lower than ultimately its fair value. So what about dividend yield theory? Well, again, we have massive undervaluation with that yield far above the 5-year average of 0.98 and the forward P far below the 5-year rolling of 41.4. So that is a double undervaluation signal. Although we have to bear in mind consumer staples does sit significantly lower at that 17.9. So how about the free cash flow payout? Well, while we want to see below 60%, it has been around that in 2024. We note over the next 12 months, growth to around 91%, pretty much the only growth we don't want to see. So don't expect a massive raise if we get one soon to the dividend. And in terms of the free cash flow, it has been very inconsistent over the last 10 years and very minimal growth as well. We have to bear in mind over the next 12 months, a decrease is anticipated to 292. Then we get sales growth. There should be no surprise here given the share price drop of nearly 50%. Last 2 years have been negative, but when we do zoom out over the last 10 years, we do see around 50% growth, 10.8 billion to 15.6, and very, very minimal movement on those shares outstanding. In fact, they have bought shares, they have done share buybacks, and pretty much the net position is a very minimal net share buyback. In terms of ROIC, whilst over the last 2 years has been around the minimum levels we want to see, bear in mind this has been reducing from 2015 and 2016 where we did see the highs of 30%. Operating margin, as always, we want increases over the longer term. Not something we see, in fact, been decreasing from the high of 2022 down to 11, then 10%. But bear in mind, if management can start to turn this business around, one step being increasing the margins, then this could be a good value play. Free cash flow margin, pretty much looking strong for 9 of the last 10 years, including 2024. And in terms of finally the net debt to EBITDA, below 3 is what we get every single year, 1.96 expected over the next 12 months. So there is a lot to like with this company, but also a lot that you do need to bear in mind before investing. And when we ultimately get to our valuation model, $110 is our intrinsic value, 109 is what Wall Street seek over the next 12 months. So they see 21% upside. Again, it will depend whether or not it fits your overall investment thesis, whether you believe a recession is looming and maybe this company will get hit harder. But at 10%, a buy at $99, at 15% around 94, and in today's episode, not far off the 20% MOS level, and as we mentioned, 21% upside from the analyst. As always, do give us your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter. We drop one every single Monday. Lots of valuable information, spreadsheets as well. And finally, don't forget to come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.